Hello, here we are for our second part of the Chapter 18 videos. So this is the personal holding company tax video. This is the second of two. We'll be done with Chapter 18 after this. So here we go, the personal holding company tax. This is another tool similar to the accumulated earnings tax used to address the whole issue of shareholders failing to take distributions or corporations failing to make distributions of earnings to shareholders. They don't want to pay that double taxation, so they say, let's skip part two where you distribute the earnings. The accumulated earnings tax was a direct assault on that. Have you accumulated too much? Is it unreasonable? The personal holding company tax is going to go a different route. It's going to say, if you're not distributing those assets, what are you doing? You're going to take the undistributed assets, you're going to do something with them. You're not just going to leave them in a non-interest bearing checking account. That would be more costly probably than doing a dividend distribution. In any event, so you're going to do something. You're going to invest in something, and what you're going to have then is a lot of investment assets sitting in there with your business assets in the corporation. And so that is what the personal holding company tax is designed to address. So it's focusing on the corporate holdings of investment assets as opposed to what it should be investing in, which is business assets. The tax base in the personal holding company tax is called undistributed personal holding company income, and the tax rate, just like with the accumulated earnings tax, is the maximum tax rate on maximum individual tax rate on qualified dividends, the same 20% that we had for the accumulated earnings tax. So when you're dealing with the personal holding company tax, we have a two-step process. Accumulated earnings basically is one step. Calculate the tax. If it's a non-negative number, you owe the tax. Here, it's a two-step process because step one is to determine whether the corporation qualifies as the thing called a personal holding company. And if it doesn't, you don't have to worry about the personal holding company tax. It does not apply. So step one, is your corporation a personal holding company? Step two, is there a personal holding company tax? So a two-step process. Step one, is the corporation a personal holding company? There are two tests here. Two tests meet both tests. So if you fail either test, your corporation is not a personal holding company. And what is your incentive here? Your incentive is to fail the test. This is not a test you want to pass. This is a test you want to fail. At least one of them. Then you're not a personal holding company and you don't owe the tax. So it's good. So the two tests, you'd rather fail them than pass them, but here they are. The first one is the stock ownership test, and that is met. This is in broad terms. We'll go through the details in just a bit. In broad terms, if five or fewer individuals own more than 50% of the stock, that's the stock ownership test. So this, unlike the accumulated earnings test, this is designed for closely held corporations. It's not going to be an issue for a publicly held corporation. Very unlikely you're going to have five or fewer individuals with more than half the stock in a publicly held corporation. Okay, so this is, I call this the personal part of the personal holding company. Do you have just a few people with control over this corporation? And test two, the gross income test. This is the holding company part of the personal holding company, where we're going to look at what kind of income is this corporation generating, and is too much of it investment type income. So if 60% or more of your adjusted ordinary gross income, which we're going to have to define, if 60% or more of that is personal holding company income, which we're also going to have to define, but that's your investment type income, then we're going to say you've passed the gross income test. You passed both those tests. So too few people controlling the whole thing and too much income coming from investments instead of business assets, that's a personal holding company. Okay, so stock ownership test. It is met if at any time in the last half of the tax year. So we're only going to look from July 1 to December 31 on a calendar year corporation. If at any time in the last half of the tax year, 5 or fewer people own more than 50% of the corporation's stock, computed by value. All right, as soon as you start counting people and ownership, you've seen this before when we were looking at controlled groups. You've seen it before when we were looking at redemptions. If we're starting to add up people's ownership, we're going to have to look at not just direct ownership, I own X number of shares of the corporation, but also indirect ownership. Somebody related to me owns shares in the corporation that are counted as part of mine. That's what we call constructive ownership. As we said before, each time you have that issue, you have a different set of rules. So the constructive ownership rules for redemptions are different from the constructive ownership rules for controlled groups, and they are different from the constructive ownership rules for personal holding companies. Each time you do it, you get a different set. In this set, we do still have family attribution. Spouses seem to be there in all of the family attribution. That's pretty universal. Siblings were not there, remember, when we were doing redemptions, but they're there now. So brothers and sisters are now part of your family, and if they own stock, you own that stock indirectly through constructive ownership. All ancestors and lineal descendants, so not just, I think one of them had children, grandchildren, and parents, but not grandparents, or any more distant lineal descendants or ancestors. Here, you go back as far as you need to and forward as far as you can till you run out of grandbabies and great-grandbabies and all those folks. Okay. As is always the case with family attribution, one step only. So the child of your sibling, in other words, your niece or nephew, is not going to, their stock is not going to be attributed back to you. Okay, one step only for family attribution. For entities, we don't have to worry about individual to entity here, as we did with, well, both controlled group and redemption. Here, it's just 5 or fewer individuals, and so we have to worry about entity to individual, but we don't have to go the other way. Any entities that own stock are not going to be counted among the 5 or fewer individuals. Okay, so stock owned by corporations, partnerships, estates, and trusts, not directly counted as 5 or fewer individuals, but they are attributed to the owners in proportion as usual to their ownership interest. So if you are a 1/3 partner in a partnership and the partnership owns 300 shares of the stock of X corporation, you own 100 shares of the stock of X corporation through your partnership. Okay, and finally, we don't do reattribution from entities to individuals, so your partner, stock owned by your partner, is not deemed to be owned by your partnership and therefore attributable to you, but they added it to the list as a separate group. So stock owned by your partner, because the person is your partner, that stock is also considered to be owned by you through constructive ownership. So there's your groups. Family members, one step only for family members. Entities, stock owned by the entity is owned by the owner of the entity, and partners, stock owned by a partner is owned by all the other partners in the partnership. Okay, those are your stock ownership tests. Let's take a look at problem number 26. Party Supplies, Inc. is owned 60% by Sylvester, 40% by an unrelated corporation. Unrelated meaning Sylvester doesn't own any stock in that corporation. How much stock is Sylvester deemed to own after he makes the following independent transactions? So Sylvester alone, he is the 5 or fewer people who own more than half the corporation. He's trying to ditch some of this stock so he can fail the stock ownership test. Will it work? Okay, we're going to transfer half of his stock to an irrevocable trust for his grandchildren. By entity to individual, the grandchildren own the trust stock. So the entity rule says any stock owned by the trust is owned by the beneficiaries of that trust. That's the grandchildren. And By family attribution, the grandchildren's stock is owned by Sylvester. Now that's 2 steps, but it's not 2 family steps. It's 1 entity step and 1 family step, and that is allowed. So here we have 2 steps to get back to Sylvester, but that's going to be sufficient to that will be allowed. 2 steps will be allowed to get that stock back to Sylvester because they're not both family steps. Okay, there we go. Oh, Sylvester still owns 60%. Now, actually, he'd have to be very careful about how he distributes this stock anyway, because if he distributes it to another individual, that's still 2 or fewer people who own 60% of the stock. And so in Part B, he transfers half of his stock to his ex-wife Chastity. There's no family attribution from an ex-spouse, and so therefore Sylvester owns 30%. Trouble is Chastity owns the other 30%, and that's 5 or fewer people, Sylvester and Chastity. Even though they don't agree on anything anymore, there's still 5 or fewer people, and they're considered to be in control. Okay. Letter C. Sale of half of his stock to an independent partner. So independent in the sense that he's not a family member, but he's a partner. Partner-to-partner attribution, Sylvester still owns 60%. Letter D, sale of half of his stock to a corporation in which he is a 60% shareholder. Other shareholders are unrelated to him, so we're not going to have any entity to family member attribution through the other shareholders. They're all unrelated individuals. So all we have to worry about is from the corporation to Sylvester. So first of all, he owns 60% of the corporation. The corporation now owns 30% of the stock. So he owns 18% that way. And of course, he still has the other 30% that he owns. That gives him total ownership of 48%. That's pretty close to 50. If the other individuals are diffuse enough that nobody owns more than about 1/4%, he can still bring together 4 other individuals, or that is to say the IRS could still bring together 4 other individuals and hopefully not find another 4 out there who collectively own another 2%. That anything over 2% more is going to put them in the more than 50% with 5 or fewer individuals. But Sylvester by himself only owns 48%, so he's got a little bit of wiggle room there, not much, but a little bit. Okay, and E, he gives half of his stock to his niece. No family reattribution from a niece, because that would be 2 steps from descendant of a sibling. And so therefore, no family reattribution. Sylvester owns 30%, but again, unfortunately, the niece owns the other 30%. There's your 2 individuals. And so we would still pass the stock ownership test. But what they asked for was how much does Sylvester own directly? And the answer is only 30%. Okay. All right, so that's the stock ownership test. That's how that works. The next one is the gross income test. And that one is met if 60% or more of the corporation's adjusted ordinary gross income, frequently abbreviated AOGI. Don't confuse it with AGI. That's an individual tax concept. It has no place in corporate taxation. But this one looks a lot like it, AOGI. If 60% or more of that, now notice stock ownership test was more than 50%. This is 60% or more. So exactly 60% will pass the test. And again, we'd rather we didn't pass the test. 60% or more of the corporation's AOGI is personal holding company income, frequently abbreviated PHCI. Okay. So 60% or more of this adjusted gross income concept is this investment type income, which is more for people than it is for corporations. That's kind of the whole point of this. And so that's the gross income test. So let's define these terms. Before we get to adjusted ordinary gross income, let's define ordinary gross income. Ordinary gross income. Now this is, I complain sometimes about Congress's use of terms. This one I really like. This is a very good term for them to use. It means exactly what you think it should mean. We know what gross income is. Ordinary income is income that's not capital gains or Section 1231 gains. So ordinary gross income, that's your gross income. Subtract out any capital gains or 1231 gains, and you've got ordinary gross income. That's the perfect name for that, ordinary gross income. You'll see when we get later with some of these other names, there's a couple that I really hate. But that one is not one. That one I like. Ordinary gross income, the perfect name for what we're talking about. Gross income that's not a capital gain or a 1231 gain. And we're just going to adjust that. So this is a pretty good name too. Adjusted ordinary gross income. We'll take our ordinary gross income and we're going to make some adjustments. First, we're going to take out rent expenses. Now that's only an issue if we have rent income. So this is not that we're paying rent to our landlord for our business property. This is we own property that we are leasing to our tenants. They are paying us rent income, and we have expenses associated with that rental income. Only 4 expenses are going to be considered there, and you see them there. Interest, like mortgage interest on the property that you own and are renting. Taxes, probably property taxes on that property. Depreciation, you know what that is, and then rent expense. Well, wait a minute, if I'm the landlord, why am I paying rent expense? Maybe you're subletting. So you are the lessee of a particular property, but you've got some unused space. And so you sublet it to somebody else, and now you have rent income from whoever you're subletting it to. And so you're paying rent expense then to your landlord. And if you're doing that, you probably are not paying interest, taxes, or charging any depreciation. Okay, but those are the only 4. So we're not going to look at insurance or maintenance costs or anything else, only those 4. Those 4 will be subtracted out in calculating our adjusted ordinary gross income. Also, if you have royalty expenses for extractive royalties, coal mines and oil wells and that sort of thing, and it's the same for interest, meaning interest on the probably the mortgage for the property that is yielding these extractive goods. Property taxes, depreciation, and also depletion would be in there, and rent expense if you're paying any rent expense. And in as with the rent expenses, you only count them up to the amount of the income that you're getting from the oil well or whatever it happens to be. One more adjustment only applies to bond dealers if you are receiving interest on U.S. obligations and you are a dealer in U.S. obligations. So you're a dealer in treasury bills or treasury notes, and you receive interest on treasury bills or treasury notes. You would subtract them in calculating your adjusted ordinary gross income. So that's not going to apply to very many corporations. It'd be a very special thing if that corporation is a dealer in treasury bills. Otherwise, it does not apply. Okay. So ordinary gross income minus these 3 adjustments, that is our adjusted ordinary gross income. So what's personal holding company income? Well, this is going to get a little bit more complicated. If you thought that was complicated, nah, that's not too bad. This will get a little bit complicated though. Okay, here we go. So first of all, the things that you normally think of as investment income, they're going to go at the top of the list. Dividends, interest, annuities, estate and trust income, because that's usually some form of investment income. So those things all count as personal holding company income. And they're saying, hey, why is your corporation investing in all these stocks and bonds and other things? People should do that, not corporations. Corporations should be running businesses. Okay, that's the thinking anyway. Okay. Then they say adjusted income from rents, meaning rents net of those same 4 expenses we talked about before, interest, taxes, depreciation, and rent expense. I say, wait a minute now, there's corporations out there that exist as real estate corporations. They purchase property, fix it up, rent it out to tenants, get rent from the tenants. That's their business model. That's a perfectly legitimate business. why would we count rent income if the corporation is in the business of renting property to tenants? And the answer is, well, okay, if that is the business of the corporation, then we won't. So if the adjusted income from rent is more than or greater than or equal to 50% of adjusted ordinary gross income, then we won't count it. Actually, there's one more test. It's got to be not more than 50% of adjusted gross income, and your non-rent personal holding company income, which would be your interest and your dividends and annuities, etc., minus any dividends paid, must be less than or equal to 10% of your ordinary gross income. So look at your dividends and interest, see if that is less than or equal to 10% of ordinary gross income. If it is, you're fine. If it's not, you can pay out a dividend. So the whole point of this thing is to penalize you for not paying a dividend, but you will get credit for a dividend paid, and all you really have to pay out is enough to get your non-rent personal holding company income down below 10% of ordinary gross income. Then that test is met. And then if your adjusted income from rents is more than or equal to 50% of adjusted ordinary gross income, you can eliminate adjusted income from rents from your personal holding company income. So these are two tests you want to pass because you don't want to count adjusted income from rents as personal holding company income. You want to get that out of there. But you can only get it out of there if you meet these two conditions. And so these ones you want to meet so you can get adjusted income from rents out of the counting of personal holding company income. So it's tricky. Some of these tests you want to fail, others you want to pass. These are tests you want to pass. Okay, so that's adjusted income from rents. You can exclude it if you meet those conditions. Otherwise, that's in there, net of those four expenses. Adjusted income from extractive royalties. Same basic deal, net of the four expenses. And again, depreciation would also include depletion there. You'll see when we get done with this page why I didn't put depletion in there. There's no room. I'm completely out of room on this page. But just remember, and actually amortization, if you've got any of that, that would also be part of that as well. Okay. While we're on the subject of royalties, gross income from other royalties. Now, these would be basically copyright royalties for books and poems and music and that sort of thing, and software royalties. So those would also be royalties. Those we will not net for interest, taxes, depreciation, and rent expense. But they will be counted as personal holding company income unless you're in the business of creating those things. Not if the income is more than 50% of adjusted ordinary gross income. And your other PHC income is less than or equal to 10% of ordinary gross income. And notice one thing missing here. I cannot reduce that other PHC income with dividends. I can do it for rent. I cannot do it for royalties, either extractive royalties, copyright royalties, or software royalties. I just got to make sure my other PHC income, mainly the dividends and interest and that sort of stuff, but this could also be adjusted income from rents if they're in there, that's got to be under 10% of ordinary gross income. If it's not, then you're going to have to exclude your adjusted income from royalties, or your adjusted income from extractive royalties, or your gross income from other royalties, no matter whether it's equal to or greater than 50% of AOGI or not. Okay, so there you go. I told you this is getting a little complicated. What's next? Oh, yes, the business expenses. I've got the business word in there twice. I just noticed that. Business expenses have to be at least 25% of adjusted ordinary gross income. So a third condition does not exist for rent, does exist for the royalty income. That if you want to exclude it, your business expenses from that endeavor, because again, they're saying, is this a business or is this an investment? If it's an investment, what's it doing in a corporation? And so you've got to have gross income from this business, more than half of your total. You got to have your other PHC income not more than 10% of ordinary gross income, and you got to have business expenses that are at least 25% of AOGI. Okay, you meet all three of those conditions, you can exclude the royalty income, otherwise it's in there. Oh, and for extractive, that they'll only hold you to 15%. Copyright and software royalties, you got to be at 25. Okay, next up, produced film rent. What if I'm a movie maker? Well, then, if it's more than 50% of ordinary gross income, not adjusted ordinary gross income, they'll let you slide with produced film rents. Okay, so you can see a lot of artistic income is coming in here. Income from royalties from books and magazine articles and poetry and music, produced film rents. If you're in the business of generating that stuff, then that's fine. But if you're not, then they're going to say that shouldn't be in a corporation. That should be it's individual. Okay. And finally, personal service contracts. Now this, you say, well, wait a minute now. I've got a little accounting practice. I've incorporated it as a professional corporation. And people come in and they get services, and those are, of course, personal services. But when your client comes in, they might say, oh, I want to see Dean Crawford. Dean Crawford saved me $2,500 on my tax return 5 years ago, and so I only want to work with him from now on for the rest of my life. Well, that's okay. That would be a personal service contract, and they would be specifying they want to see me. Well, that's fine. They're allowed to do that. But generally speaking, the contract does not allow them to specify that I will be the one performing the service. So they can request it. And of course, we can do everything possible to honor our client's request. Why wouldn't we? Of course we would. But contractually, we could say, sorry, Dr. Crawford is not available. You're going to have to work with some other person, but they're just as good. You'll like them, we promise. And so contractually, you cannot require a particular person. Typically, in a medical practice, an accounting practice, a law practice, you have people that you're accustomed to working with, but it's not a contractual thing. Okay. As opposed to, suppose you have a corporation that says, we will get you a particular star. We'll get you Tom Hanks. As soon as he gets over the coronavirus, we'll bring you Tom Hanks, and Tom Hanks will do your event for you. Well, you're going to want to specify in that contract, you said Tom Hanks. I'm not paying Tom Hanks kind of money if you're going to give me somebody who's only been in 3 movies and nobody's heard of him. Okay, so forget that. We said Tom Hanks. We're not paying that kind of fee if you don't get me exactly who I specified. And so I want somebody that I specified. I'm going to put that in the contract. That's a personal service contract that is going to be counted among the personal holding company income. All right. So there you go. That is personal holding company income. It is basically investment type income, but we're going to bring in rent income unless you're in the rental business, royalty income unless you're in the royalty generating business, produce film rents unless you're in the produce film rent generating business, and personal service contracts if the individual named is, number one, a 25% or more owner, and number two, contractually required to be the one performing the service. That's personal service company income. Okay, let's take a look at problem number 29. This is the B-Flat Music Supplies Limited. They have dividend earnings of $30,000, interest of $12,000, adjusted rent of $50,000, gross income from the business of apparently selling music supplies of $63,000 in this particular taxable year. Now, the first question they say is B-Flat a personal holding company? And the first thing we'll notice is there is absolutely nothing in there about stock ownership. Let us assume B-flat is owned by 5 or fewer individuals who own all of the stock, so more than 50%. So the stock ownership test, we will assume, is passed. The gross income test we have to figure out. So here's what we're going to do. We're going to set up a table, and we're going to set up some columns. I recommend this table whenever you're doing a personal holding company problem. It's a very handy table for solving the gross income test. So we'll put gross income in this column, ordinary gross income in the next column, adjusted income from rent. Sometimes you need it, sometimes you don't. In our case, we will need it. And then adjusted ordinary gross income and personal holding company income. Okay, so what they say we have? They say we have dividends of $30,000. They say we're just going to do the gross income column first. They told us we had interest of $12,000. They told us we had adjusted income from rent of $50,000. They didn't actually say how much rent income we have and how much of those 4 expenses, interest, taxes, depreciation, and rent expense, if any, that we had. I decided to modify the problem a little bit by saying that the rental income is $80,000, because otherwise I couldn't do the gross income column, and I wanted to show you the whole table. So I decided that the expenses that they were talking about are $30,000. Okay, so we'll set up a line for the rent expenses. We're not going to use it for gross income, though, because obviously rent expenses don't go into gross income. They're deductions. Okay, but anyway, so that's going to be 30 when we get there, but we're not there for this column. And then finally, oh yeah, we actually sold some music supplies. So the business income, now this is gross income, so that's revenue minus cost of goods sold. That is $63,000. So this corporation's gross income, with my slight modification on the rent income, is $185,000. Is it ordinary? The dividend, interest, rent, and business income, yes. All of that is ordinary, so ordinary gross income is also $185,000. Adjusted income from rent, there's the $80,000 of rent income, and now we bring in the rent expenses of $30,000. So our adjusted income from rent, adjusted for those expenses, is $50,000, which is the number they gave us in the book. The 80 and the 30 I made up, but I knew they had to net to 50. Okay, so what is our adjusted ordinary gross income? Well, here's our ordinary gross income, same as the OGI column, and then the one adjustment we have is the adjustment for the rent expenses. So adjusted ordinary gross income is $155,000. What is our personal holding company income? Well, clearly we have to put in the dividends and the interest. Then the next question is $50,000, our adjusted income from rent, is that more than 50% of adjusted ordinary gross income? And obviously it's not. 50,000 is 50% of 100,000. 50% of 155,000 is 77.5. So that's a big no on that. It's not 50% or more of adjusted ordinary gross income. So we failed that test, and we cannot say that we're in the rental generating business. That means we have to include adjusted income from rent in personal holding company income. And so there it is. So we got to put it in there. Clearly the business income from actually selling music supplies is not in there. So our personal holding company income is $92,000. Okay, so there's the table all filled out. Now the question in letter A is B-flat a personal holding company with this information? And we said we would assume the stock ownership test was met. So it's all about the gross income test. Is $92,000 greater than or equal to 60% of 155? The answer obviously is no, because 60% of 155 is 93. So no. So we went through all that with the rent expense and stuff, worried that, oh, by having to include that, that's going to push us over the limit, but it didn't quite. B-flat is not a personal holding company, but stay tuned. Letter B, if the dividend income was $35,000 instead of $30,000. So here's our table again, but the dividend income, we're going to change that to $35,000. And of course, now we have to change our totals down here. So these are the new totals with that extra $5,000 added to every column except adjusted income from rents was not affected. The other four were. Okay. So now the question is $97,000 greater than or equal to 60% of $160,000? And the answer is yes. 97 is bigger than 96. And so, assuming the stock ownership test is met, B-flat is a personal holding company. All right, so that's how that works. And again, I recommend that chart or something like it. You're going to have to adapt it for your particular situation. You won't always need the column for adjusted income from rents, for example. You will always need the column for adjusted ordinary gross income and personal holding company income. You may or may not need the other ones. You're probably going to want to know what ordinary gross income is as well, because that's going to figure in a lot of cases when you have rent income or royalty income. By the way, notice that our non-rent personal holding company income is $47,000 here, which is, or even if you go back to the old one, it was $42,000, and that was way more than 10% of ordinary gross income. And there were no dividends paid. So even if we had, where was I going? Oh yeah, even if we had passed the 50% test for excluding the rent income, then we would have had to go to the non-rent personal holding company test, and there's no way we were going to pass that one anyway. Okay, so there we go. That was problem 29. Now, all we've done so far is answer the question, yes or no, is this corporation a personal holding company? We have done absolutely nothing about actually computing the tax if the answer is yes. But we decided B-flat in our second iteration, the answer was going to be a yes. So now we need to know how to do that tax. It is the tax base, undistributed personal holding company income. Now, I told you there was a name I didn't like. I absolutely hate this name because what did we just do? We just got done figuring out what personal holding company income was for this corporation. We just spent huge amounts of time going through what personal holding company is. I can't tell you how many students have looked at that and said, oh, okay, I just spent half an hour figuring out what personal holding company is. Now all I have to do is subtract out dividends and I've got undistributed personal holding company income. Makes perfect sense. Totally wrong. Unfortunately, this is a terrible name because it's misleading. And I can't even give Congress a break and say, well, okay, they came up with this term and they didn't realize this other term had already been taken. No, the personal holding company provisions were all enacted together. So whatever congressional staffer came up with the name personal holding company income also came up with the name undistributed personal holding company income. Didn't care that they were very similar and this term would be misleading. And apparently the members of Congress who were working with that person also didn't care or didn't notice or whatever. Anyway, it's a terrible name. Don't let it fool you. It is not calculated by taking the personal holding company income and subtracting out dividends paid. It sure looks like, based on the name, that that's what it should be, but it's not. The actual calculation of undistributed personal holding company income is going to be very similar to the calculation of accumulated taxable income that we learned with the accumulated earnings tax. Okay, but the tax itself is the undistributed personal holding company income, that terrible name, times the maximum dividend tax rate. We know that is 20%. So this terribly named undistributed personal holding company income, as I said, is very much like accumulated taxable income for the accumulated earnings tax. You'll take taxable income and adjust it, although they're not the same adjustments as for the accumulated earnings tax. These are going to be different adjustments. And again, that's just my name, adjusted taxable income. You won't find that anywhere in the code or the regs. There is a dividends paid deduction. just like with the accumulated earnings tax. There is no equivalent to the accumulated earnings credit, though. So undistributed personal holding company income is just taxable income as adjusted minus the dividends paid deduction. Okay, so adjusted taxable income, start, of course, with taxable income. A lot of these adjustments are going to look very familiar. Take out federal income taxes. Take out the charitable contributions in excess of the limit on deductibility of charitable contributions. Because, of course, the ones under the limit are already deducted in computing taxable income. So we're saying the ones you couldn't deduct, you can subtract out here. The net capital gain, net of tax. That's also part of this. If you had a dividends received deduction in your taxable income, you have to add that back here. If you had a net operating loss deduction carryover from a prior year, you have to add that back here as well. But unlike the accumulated earnings tax, there's an exception. If it is from the immediately preceding year, so we're working on 2020, if you had an NOL in 2019 and you deducted that in the calculation of your 2020 taxable income, you do not have to add it back. All other NOL deduction carryovers from years prior to 2019, you would have to add back. But the NOL from the immediately preceding year, you can leave alone. You don't have to do that add back. Expenses of non-business property, if you generated income from your non-business property and you deducted expenses from the non-business property, if you deducted expenses in excess of the income, so you actually had a non-business property loss, you've got to take that loss out of it. You've got to add back the expenses in excess of the related income. Okay. So that is, let's go back there, that is your adjusted taxable income. Very similar, but not exactly the same as adjusted taxable income for the accumulated earnings tax. Now the dividend, whoops, going the wrong way. The dividends paid deduction is also similar, but not the same as the dividends paid deduction for the accumulated earnings tax. Current dividends are current dividends. They count. Couple of conditions that we didn't have with the accumulated earnings tax. These must be pro rata. You cannot have a non-pro rata distribution and count it, which you could for the accumulated earnings tax. And if you had a property dividend, you must value that property at basis, not fair market value. The normal rule for dividends and the amount you're going to actually get taxed on as an individual shareholder is fair market value. But we're going to value these for the purposes of the dividend paid deduction at basis. Dividends paid in the first 2.5 months of the subsequent year will be deductible, but again, they also have to be pro rata. And here's a condition that can be very binding. You cannot exceed 20% of your current dividends. If your current dividends are 0, 20% of 0 is 0, and you cannot use the dividends paid in the first 2.5 months of the subsequent year. That was not the case with the accumulated earnings tax. We could hold off on paying dividends until the year is over and then pay them all in February or January or even the first 15 days of March and still claim them as part of a dividends paid deduction. That is not the case here. You can do consent dividends, and there's not going to be a limit there. So you can do a consent dividend at any time before you file your tax return. If you file your tax return and you owe a personal holding company tax, but you don't know it, or you didn't look or whatever, and you didn't calculate a personal holding company tax. Maybe you did a calculation and you said, okay, we failed one of the tests. And then the IRS looks at it and says, wait a minute, you forgot to count your partner's shares when doing the stock ownership test. You actually do have 5 or fewer individuals with more than 50% ownership in the last half of the year. You are a personal holding company. You are liable for the tax. And you say, okay, we forgot, you're right. So IRS, we will concede that you are correct in your assessment here. We want to do a deficiency dividend right now. Now, this could be years later. You've got within 90 days of the final determination of the personal holding company tax. So it could be 3 years after the actual tax year in question, when the IRS audited your return, made that determination and say, hey, you owe us personal holding company tax. You say, oh, we're going to do a deficiency dividend. You've got 90 days from the day they tell you that. Or if you take them to court, you've got 90 days from the time the tax court hands down the decision. If it's not in your favor and they say you are liable for the tax, you can do a deficiency dividend right then, within 90 days of the court decision that says, nope, sorry, the IRS is right, you do owe that tax. Now, interest on that and possibly also penalties will still be payable. So you're going to be paying interest on a tax that you don't end up owing. But you can avoid the tax itself with a deficiency dividend. Okay. A dividend carryover. This is something the accumulated earnings tax doesn't have. Suppose that you did your undistributed personal holding company income. I hate that name. You did your undistributed personal holding company income last year, and after subtracting out the dividends paid deduction, you had a negative number. Or from the year before that, you had a negative number. You had a negative number because you paid more dividends than you had to for the personal holding company tax. That's the carryover. Excess dividend from the last 2 years, excess dividends paid deduction, if you deducted more than you needed in last year or the year before, you can use that excess this year. So you can carry over those excess dividends, not for too long, only a couple of years, but you do get it for a little while anyway. So that is your dividends paid deduction. And that's it. That is undistributed personal holding company income. Okay, problem number 30. Lark Enterprises, Inc. is a personal holding company. So we don't have to worry about part 1 there. The test, they said it is a personal holding company, period. That's been determined. From information below, compute the maximum dividends paid deduction. So we're only worried about the dividends paid deduction. We're not going to do the complete calculation. We will do that in the next problem. But for this one, we're only interested in the dividends paid deduction. So what is our dividends paid deduction? In letter A, land with a basis of $10,000, value of $50,000 was distributed during the taxable year to the two 50% shareholders as equal tenants in common. So that's a pro rata distribution. Each of the two 50% shareholders got a 50% share, a 50% ownership interest in this land. That will count as pro rata. So it's a current dividend, and that is valued at basis of $10,000, not at fair market value of $50,000. But at least we get the 10. Okay, letter B. 2 months later, now later than what? I guess that's got to be later than the December 31st year end. So I decided that was February 28th. 2 months later, cash of $5,000 was distributed to one of the shareholders. Sorry, not pro rata. Can't count it. It was distributed to one of the shareholders. Then on March 31st, 3 months later, which I assume means 3 months after year end, property worth $5,000 is distributed to the other. Well, that now does make it pro rata, but sorry, too late. You got till March 15th. This is March 31st. Okay, so nothing in letter B helped us. On February 10th of the following year, $3,000 was distributed to each shareholder. So there's a $6,000 distribution on February 10th. That is within the 2.5 month period. $6,000 was distributed. We're limited to 20% of current dividends of $10,000. That's why we can only take $2,000. So it really doesn't matter about the letter B distributions because we were only going to get a total of $2,000 from B and C together anyway. So the fact we couldn't use B doesn't matter because C used up the full 20% by itself. Okay, and then letter D, a timely election was made to treat $5,000 each as consent dividends. Okay. So the consent dividend, that's going to be $10,000, $5,000 each for the two shareholders. And so there it is. So our total dividend paid deduction is $22,000. That is problem 30. 39, this is the other comprehensive problem. Marital Aids, Inc., why not, reported the following results last year. Gross income from sales. We've got that. We've got salaries. We've got a bunch of stuff in this table. Corporation has only 4 individual shareholders. Now, what they mean by that is they only have 4 shareholders and they're all individuals. They don't have 4 individual shareholders and a corporation that owns 60% of the stock. We would fail the stock ownership test in that case. What they're saying is there are 4 shareholders who are all individuals, probably unrelated, doesn't matter. There's 4 of them and they own 100% of the stock, and therefore they will, that's 5 or fewer people who own more than 50% of the stock. So that's the stock ownership test. Okay. Compute the following. So we're going to need adjusted ordinary gross income, personal holding company income, and undistributed personal holding company income. So first of all, we're going to have to determine whether this is a personal holding company. They've said there's only 4 shareholders. They're all individuals. So that's the stock ownership test. We need to see about the gross income test. We'll set up our table. We're going to need taxable income, and we're going to have ordinary gross income. There's no rental income in there, so we can skip that one. Adjusted ordinary gross income and personal holding company income. And so what do we have? First of all, let's do the taxable income. So the sales income, that's gross income from sales. So that is revenue minus cost of goods sold of $50,000. Salaries, that's an expense. We'll subtract that, $20,000. Overhead, another expense of $25,000. There's a capital gain of some sort, $200,000 in capital gains from whatever. They don't say what. They don't even say long-term or short-term, but this corporation doesn't matter. The net operating loss from the prior year, yes, from last year, $30,000. We have dividend income of $40,000. There is tax-exempt interest of $10,000 and taxable interest of $35,000. So we'll leave the tax-exempt interest off altogether. That's not going to figure into this calculation anywhere. Okay, so leave that off. And then finally, a dividends received deduction. Now, they weren't actually specific, except that the dividends were from U.S. corporations. How much did they own in the U.S. corporations? They don't say. I assumed it was less than 20% ownership, so just typical investor type ownership. So a dividends received deduction of 50%, it would be $20,000 or 50% of the $40,000. So that gives us taxable income of $230,000. Okay. So we're going to need that later on, and so now we have it. All right, now our ordinary gross income. Well, the gross income from sales is clearly ordinary. The capital gains is not. And of course, the expenses, that's not income at all. The capital gains is not ordinary, so leave that out. But the dividends and the taxable interest are part of ordinary gross income. So ordinary gross income is $125,000. Adjusted ordinary gross income. Well, we have no rent or royalty income. This is not a bond dealer. It's a dealer in marital aids. And so therefore, there's no subtracting of any of that taxable interest. And so there we go. This is adjusted ordinary gross income is the same as ordinary gross income, $125,000. And personal holding company income, just the dividends and interest. There is no other candidate for personal holding company income. So that's $75,000. Okay, so there's our table. Now, letter A, adjusted ordinary gross income was $125,000, and personal holding company income was $75,000. 75 divided by 125 is, oh darn, exactly 60%. Now, if that was $74,999, it would be less than 60%, and we would not have a personal holding company. However, it is 60%, and so we do. So letter C, we now do need to figure out undistributed personal holding company income. And we can't just take the $75,000 and subtract dividends paid. Wouldn't that be nice? But no, we take our taxable income of $230,000. And then we've got to make those adjustments. First of all, subtract out, well, I guess I added first, the dividends received deduction of $20,000. Now I can subtract the federal income tax, $230,000 times 21% is $48,300. The net capital gain, well, the capital gain was $200,000. The tax of 21% on that capital gain was $42,000. So what that tells you is that the federal income tax, the total tax, only $6,300 was actually on ordinary income. The main part of the federal income tax was the $42,000 paid on that $200,000 capital gain. So anyway, $158,000 is the net capital gain, net of tax. Okay. So undistributed personal holding company income, add it all up, it is $43,700. Then they ask, letter D, what is the current dividend? So it's not quite the end of the year yet. Current dividend that would be required to avoid the personal holding company tax. Well, we have no dividends paid deduction now. So we need one. We need a $43,700 deduction. And so that, if we're going to do it with a current dividend, if we're, so it's December 30th and we're adding up everything and we're closed on December 31st. Although I don't know, would a shop like that be closed on New Year's Eve? Probably not. Anyway, we know what our numbers are, but it's still, the year hasn't ended yet. And so we need to know what is our current dividend. And so, there we calculate it. We need to do a $43,700 dividend. Okay. And finally, letter E. What impact would it have if taxable interest was only $12,000 and there was no NOL carryover? Okay, first of all, the NOL carryover is absolutely irrelevant. The only thing that's relevant is changing interest income from $35,000 to $12,000. The NOL has no bearing. Adjusted ordinary gross income, if you drop that by $23,000, because you've reduced interest income from $35,000 to $12,000, that's only $102,000 now instead of $125,000. And personal holding company income, if you drop that by $23,000, it is now $52,000 instead of $75,000. And then when you divide that through, it doesn't come out even, but it's in the neighborhood of 51%. I rounded that to the nearest integer percentage. I don't remember what the exact amount was. It was not an even number there. But anyway, it's definitely under 60, which is the important thing. Okay. So that means the corporation is, I'd say no longer, I guess I should say, is not a personal holding company under this revised assumption of the interest income. If it turns out, oh yeah, I told you that we had $10,000 of tax-exempt income and $35,000 of taxable interest, and then, oh, whoops, no, it was $33,000 of tax-exempt and $12,000 of taxable. So you just misclassified $23,000 of interest income as taxable, as it was tax. You classified it as taxable. It should have been non-taxable. I guess that could happen. Anyway, it seems like a pretty big mistake. But if that was what happened here, then the corporation is no longer a personal holding company. And so that $43,700 undistributed personal holding company income is no longer relevant. So you don't have to pay 20% of that as a personal holding company tax or pay yourself a $43,700 dividend to avoid it. All right. And that is everything on personal holding companies. So that finishes Chapter 18. We are now done with Chapter 18. And what that means is that we are now done with C corporations. The corporate sector of this course is now over as of this point. Our second exam covers chapters 16, 17, and 18. All right. Thank you very much. See you next time.